American business history is defined by companies that built empires. They construct towers of glass and steel, projecting an image of unshakable prestige and innovation. But inside those boardrooms, the demand for infinite growth creates immense pressure. When executives cannot hit their targets legally, some turn their visionary companies into machines of deception. We are looking at 20 of the most notorious corporate scandals in American history, examining how household names and Wall Street giants fell into fraud, bribery, and consumer deception. These stories expose a pattern of systemic failure, where corporate cultures rewarded deception until the resulting damage shattered public trust. Enron built its reputation as a brilliant energy company. Behind the glass walls, executives engineered off-balance sheet shell companies to hide massive debt from their investors. When the numbers finally unraveled in 2001, the company collapsed into bankruptcy. Employees lost their life savings, and the fallout took down Arthur Andersen, one of the oldest auditing firms in the country. Months later, the telecommunications giant WorldCom tried to maintain its own illusion of rapid growth. Accountants improperly categorized everyday operating costs as capital expenses, artificially inflating their financial results to impress regulators. WorldCom's massive fraud demonstrated that the early 2000s corporate boom relied on numbers that investors could no longer trust. Sometimes the deception targets the consumer directly. Wells Fargo relied heavily on a wholesome local banking image. Inside the branches, intense pressure to hit sales quotas drove employees to open millions of unauthorized accounts in their customers' names. Purdue Pharma built a blockbuster business out of powerful pain medication. Government investigations focused on the aggressive marketing of OxyContin, showing how the company pushed prescriptions through doctor networks despite addiction risks. They did not build this sales machine alone. Prosecutors stated that the elite consulting firm McKinsey & Company advised Purdue, actively designing strategies to turbocharge those opioid sales targets. A similar collapse of priorities hit the aviation industry. Boeing, long respected for its engineering rigor, faced a fraud conspiracy charge over how regulators evaluated the 737 MAX, following 2 deadly crashes. When internal sales goals and high-speed production timelines override medical ethics or engineering caution, the resulting corporate decisions directly threaten public safety. The modern technology sector often values a compelling story over proven science. Theranos promised to revolutionize medicine with a single drop of blood, raising billions before the technology proved completely non-functional, and founder Elizabeth Holmes was convicted of defrauding investors. A few years later, FTX positioned itself as the safest, most mainstream crypto exchange on the market. In reality, founder Sam Bankman-Fried secretly diverted billions in customer deposits to a shadow trading firm named Alameda Research. The tech ecosystem consistently rewards visionary founders who project absolute confidence. That culture of personality allows charismatic leaders to amass billions before anyone audits the underlying financial or scientific reality. Wall Street relies on complex math to assess risk. In the lead-up to the 2008 crash, Lehman Brothers utilized an accounting maneuver known as Repo 105 to temporarily move debt off their books, making the firm look stable for quarterly reports. When market confidence evaporated, the hand leverage destroyed the firm. Lehman filed for bankruptcy, instantly triggering widespread panic across global trading floors. One failure threatened them all. AIG took on immense risk through credit default swaps, tying its survival to the collapsing mortgage market. To prevent the financial network from disintegrating, the government launched a massive rescue using billions in taxpayer money. At the base of this crisis was Countrywide Financial. The lender aggressively fed the housing bubble by issuing unsustainable mortgages, approving loans for families who had no realistic way to pay them back. These companies operated on moral hazard. They captured immense private wealth during the boom, and when their reckless strategies imploded, they forced the public to absorb the massive financial losses. Global finance provides another avenue for severe misconduct. Goldman Sachs arranged bond deals for a Malaysian sovereign wealth fund, a scheme that ultimately channeled billions of dollars into international bribes and misappropriated public money. Data is the new global currency, carrying its own vulnerabilities. The FTC issued a $5 billion penalty to Facebook after the company deceived users about how their personal information was harvested and controlled. Sometimes the data is taken by force due to weak security. The credit bureau Equifax suffered a catastrophic breach, exposing the records of nearly 147 million people, many who never chose to use their services. In a heavily digitized economy, poor corporate compliance is a universal threat. When a powerful institution fails to secure its systems or police its global operations, the fallout immediately becomes a public liability. Not all fraud requires complex algorithms or international networks. Executives at Tyco looted their own company, treating corporate funds as a private wallet for unauthorized loans and massive personal bonuses. Adelphia Communications operated as one of America's largest cable providers. The Regas family controlled the board and ran the public corporation like a private empire, hiding immense amounts of debt from the very shareholders who funded it. HealthSouth built a massive healthcare services brand while running a systematic accounting scheme in the background. Finance officers artificially inflated earnings to ensure they met Wall Street's relentless quarterly targets. Severe corporate misconduct frequently stems from unchecked executive authority, bypassing basic internal controls, leaving investors entirely in the dark. Rapid global expansion tests the limits of oversight. Walmart faced intense federal investigations into its foreign operations, eventually paying massive penalties for failing to prevent bribery in international markets. J.P. Morgan faced regulatory action for manipulating markets using a tactic called spoofing, entering clusters of fake orders into the trading system. These false signals trick algorithms and investors. Once the market price shifts, the fake orders are canceled instantly, allowing traders to profit. Even the most trusted household names carry deep legal liabilities. Johnson & Johnson has spent decades defending its legacy against massive lawsuits concerning the safety of talc products, faulty medical devices, and opioid operations. A century of positive branding provides no immunity against the systemic pressures that drive corporate misconduct. The mechanisms of deception vary from company to company. Some manipulated accounting ledgers or rigged financial markets, while others sold addictive products or neglected to protect consumer data. The underlying architecture is identical. These organizations prioritized short-term numbers, systematically dismantled internal oversight, and penalized the employees who tried to warn them. A culture that rewards the illusion of success eventually shatters. The true cost of corporate greed is that executives rarely absorb the damage when the towers finally fall, leaving ordinary people to pay the ultimate price.